So in that streaming room, and then to humiliate myself even more, I'm recording it. So this is great. So many places to sort of make me accountable. Luckily, it's only for a half hour. But all kidding aside, is I wanted to go over long-term trades, swing trades, and everybody sort of knows I have the reputation for day trades. So I thought I'd show you what we're talking about in here. So the first thing is long-term ideas. Now, is long-term ideas mean a month? No, that's more a swing trade. This is a long-term idea. Now, on the futures room, Neil is all over this trade. So when you get a long-term base, I mean, that's years. And when it breaks above it, there you go with a long-term trade. So the first thing you might ask is, where on earth do you get out, though? Well, the first thing is, when I see that type of breakout, the first thing is the width of that long-term rectangle. That's your first objective, which right there is about 125. I don't know if that's called cents or dollars. That's for Neil to say, but it's 125. So 125 from 450 gets you to 575 right there. So you might be like, well, what do I do? Do I stay in it? Well, usually when I see something get too far from these moving averages, usually I get out of half. That's number one. Number two, if you wanted to stay in, then I'd ride it to like the 20. That dotted line right here is the 20, and that's a monthly. So you could see this on a weekly also, but for an ultra long-term trade, you'd probably get yourself out here. Yeah, you got yourself out probably too early. And there you go with another thing. If it gets too far from these moving averages, you get out of a half, and then it gets too far again, you get out of half of another half, and then you're completely stopped here. But that's what I mean about a long-term trade. It took years. So that's a good one. Now, I'll show you with something similar about a swing trade, and we're in it. So you go to the DBA. This is the agricultural ETF. You see on a monthly, it looks pretty darn good. But go and check it out on a weekly or a daily. There's a bull flag for you. Do you know exactly where to get out? No, you don't know exactly where to get out. So just as you see, it's held every support. And what we did is we bought all the way down, average down. I hate averaging down, but I saw corn, I saw wheat, and I'm like, we got to stay in this. Now, the proper way to do it is to buy on the breakout. Why? Let's say you buy 1,000 shares all the way down. So that's $20,000. But then it's the time cost of money. You don't know when it's going to break out. So when it broke out, it's 22 now. So sure, you make your $2,000, but it might have taken you 3 months. On the other hand, if you bought it when it broke out, you make your point in 6 days. That's why I like that. But that's a swing trade. So I'm not out yet. Now you might ask, well, you just said if it gets too far from the moving averages, why don't you get out of some? Well, yeah, I should be getting out of at most at a quarter right in here. I should post it. I'm getting out of a quarter, and I'll do that when I get off all the dual broadcasting stuff. The second thing on a swing trade, you have to go back and see where the resistance is. Obviously, in here, you don't see any resistance. How about on a weekly chart? You see the resistance. That's exactly why you get out of a quarter or maybe a half. That's a darn good trade. So just keep that in mind that if you get in something and it starts going parabolic, I would get out of a quarter of it. Definitely a quarter of it. Now, there is another one, Jace. Yeah, I called this one about hurricane season. I grew up in Florida. I'm obsessed about all the hurricane stocks and all that. So here's another swing trade, GNRC. So we bought GNRC on May 11th. Now, you might ask why May 11th, and sure, everybody's probably pissed off here, but we bought spreads. If you go back to May 11th, June 1st is the official start of hurricane season. But May 11th, every year, it's incredible. When did this start going up? May 11th. And I'm telling you, you go all the way back, it's May 11th. But here you go. I got out of all my spreads. Why did I get out all my spreads? Long-term resistance. And it's getting pretty far from all these moving averages. Now, you might be like, yeah, but there's some tropical storms out there. I've seen it time and time and time again. It comes out that the tropical storm withers and dies, and this goes back to 123. And darn right, we'll get back in it. But that was a swing trade. So, monthly chart or weekly, I'm not sure about that. I'd be much more likely to do an ultra long term trade if this was over one of the moving averages and this flattened out. You don't see that. You go back to corn, and you see on how it flattened out. So it all flattened out. Now, you might say, why didn't you buy it at the moving average? Because really, in the grand scheme of things, it was in a big old rectangle with a lot of resistance. Same thing. You could have bought here, but it would have taken you 4 months for you to really make money. When if you would have bought it here, it takes you a couple of weeks. So long-term trade is when you get over at the minimum the 50 simple moving average on like a monthly. Which brings me to the overall market. You might say, well, this isn't a long-term uptrend. Yeah, it sort of is, but I don't like this. I don't like when the MACD is this overbought and the long-term MACD part, the slower moving, is under zero. I think that's real dangerous. The other thing is you need certain things in your favor. And what I mean by that about having things in your favor, go and check out the SPX and look at the SPX on a monthly chart all the way to 1982 when I started in the business. I actually started in 1980. I worked for a boiler room, believe it or not, like Wolf on Wall Street. And everything you've heard about all the hedonistic, horrible stuff, it's true. Yeah, it's true. So I got out of there after a year and went and as a clerk in Chicago. But the big rally was in 1982 when interest rates were lowered by Volcker. That's when you got the massive rally. You had this rectangle for years. Yeah, there's another rectangle. So the thing is, though, is why did the SPX go into a long-term uptrend? Now, you might say, yeah, but it's had some twerks down. But overall, the trend's been up. And one of the reasons the trend has been up is because the bond market has been going down. That's yields. And the yields have been going down until now. And now the yields are above here. Yields have a lot to do with the overall markets because there are other places to put your money. So 1 year right now, you could get 5%. So keep that in mind. So long-term uptrend, you really need other things in your favor. And when I see the bonds break down, but I see the SPX working off any kind of oversold on, let's say, a monthly chart, while the bond market is getting destroyed or interest rates going up, I don't believe about this being continuing a long-term uptrend because the bonds had a 40-year uptrend they broke. The stock market had a 40-year uptrend. So I just think the writing's on the wall that's extremely dangerous now. But getting back to it. So I showed you corn as a long-term idea. I showed you GNRC as a swing trade. So you could say Tesla also. Uh, Now, this is a true story. You can't make this stuff up. You know, Tesla's been in a big old uptrend. So long term. So when we sold our house in Florida, you can't make this stuff up. A 94-year-old person bought our house on the river with Tesla stock. Yeah, you can't make that stuff up. So believe it or not, so I had to watch every earnings report and all that until the close of the house. But yeah, he bought it. He was 96 and he bought the house. Unbelievable. So of course I didn't just take Tesla stock. I took the money and ran. But obviously that's a long-term uptrend, or it was. And here you go again. You got too far from the moving averages. You get out of a quarter. You get out here, it gets too far. You get out of another quarter. And then when it crosses like probably a 20, that dotted line, you get out of the rest. So just keep that in mind. That was also an extremely long-term trade in there. So where do we go now? Well, the first thing is I want to show you short-term trades as well. So let me just show you some of the short-term trades. Usually the short-term trades work better with like bull and bear flags, but do you see this? And you saw it in DBA on a daily chart. There. So you can have them on weekly and daily charts, definable patterns. Also, when I do longer term trades, the more times you can connect trend lines, like you could in corn, the more significant. So the more points of contact. And you know, and I know that probably most people fell asleep while it was building that base for 7 years. So just keep that in the back of your mind about those trend lines do matter. Now, getting to shorter term trades, how do we trade those? Well, the first thing I do in here is I definitely watch bonds. I watch, I watch all the criteria. I watch even long term. But then I'm going to look at this same exact thing. I look at bear flags, I look for bull flags, and I look at the moving averages, and I look at the MACD. The first place I start on a shorter term thing is to determine if something's in a daily uptrend or downtrend. When it's vacillating around here, well, it's a tough one. But if you get this blue line of the MACD decisively over zero, and this is over the 50, yeah, that to me is an uptrend, a shorter term uptrend. When you see that, yeah, that's more a that's more a 2-week trade until proven otherwise. In fact, I'll show you. I'll go into studies and you edit studies, and I can take off a lot of these, but I'll just use the 20. So the 20, if you look in here, is a dotted line. I'll make it bigger for you. There. Take off the trend lines. We were using those all day today. So if you bought, like I said, the more times that you could connect the trend lines, the more significant. And you bought on the break, you could stay all the way in until it broke the 20. Did you miss that? Yeah. But did you make 200 points? You sure did. So that's one thing. Bull flags on, let's say, a 4-hour chart. Now let's go to my bread and butter. My bread and butter are these bear ledges. And let me show you some of them of what I'm talking about. First things first, a bear flag. A bear flag is this. A bear flag is that, or actually that, sort of upward sloping. After a sell-off, a Brecher ledge is a bear flag with a horizontal right there. So there are a couple of caveats. Number one, you don't want support underneath. You don't want support underneath, or it's less likely to work. It's all about probability. So definitely understand it's definitely about probability. So let's take a stock that looks like garbage. Now, let me just tell you, on the chart pattern mastery, or if I'm in the option room or the free room, it's a community. So ideas are encouraged. So one of our loyal clients showed me that Brecher Legend SMCI. I'm going to take off some of these things. There you go. There's your Brecher ledge. You had a prior sharp move down, and then you consolidated with a horizontal line that you could draw beautifully. And the second it broke that was it. That was good for 20 points. Now, you might say, why aren't there more Brecher ledges while the market's gone straight up? I have no problem with buying bull flags. But I'm telling you, in a bad market like last year, we cleaned up with Brecher ledges. So just keep that in mind in there. Any of them, Apple, Tesla. I don't fall in love with the stock. I fall in love with the chart pattern. So you could see this year, yeah, it looks fine. But if you go into last year, well, it's hard on a weekly chart to see it. But all of these had Brecher ledges all the way in here. All in there with not a lot of support on the way down. The biggest mistake I see is trying to do some kind of bearish pattern when there's a bunch of support on the way down. And I'll show you a perfect example today. Here's the ES. The ES got walloped on the opening. Walloped on the opening. Looks like it was going to crash until you look at the support. The more times you could connect little dots like this, like prior bottoms, the more support it is. And that's why it stopped right there. On the other hand, guess what? Where did it stop on the way up? Where it broke down. So now you have, just like you had in corn on a monthly chart, you have a rectangle, but this is a shorter term one. So definitely I'm going to respect the break in either direction. If it breaks down here, well, you see the support. I mean, I can't make that up. There's your support. If it breaks that support, yeah, you're looking at the other little candles down here. Now, you might say, well, how about that candle right there? Well, that's one day. I don't know if you call that real support. I want multiple lines. So maybe in here because of back here. But that's how we're short-term trading, is we're trying to find bull flags and bear flags. Don't get me wrong. We look at bull flags all the time. Go look at ServiceNow, not today, even though now you're seeing bear flags. But look at these bull flags on the way up. Nobody believed it could have another leg up, but there are your bull flags. And there are your bear flags. So I'm totally agnostic with these stocks. I don't look up anything other than earnings or companion stocks. So if a stock like MongoDB is getting destroyed, these bearish patterns are more likely to work. That's all it means to me. So that's how I'm showing long-term trades, swing trades, and heck, you could call that a swing trade. You know, that's for 3 days. And then the shorter term trades, definitely ultra short term. Now, when I talk about swing trades, we can also have intraday swing trades, which means we stay in them all day. So it doesn't have to be like by the time I send an alert, I'm already out. I made that mistake. That didn't go over very well. So definitely that kind of thing you can stay in for hours, Each one of these is an hour. Definitely could stay in that. But I want to do alerts where you have more than enough time to get in them and out of them. So you could see this right now. I think you see right now, if I was posting an alert right now, I'd be putting, remember, the more times you touch, the more important. Now, if this breaks here, the tighter the pattern, the tighter the stop. Now, I'm not saying trade service now, but if you shorted here, you just put in your stop like here, you're risking about 70 cents. And you know what? If you get stopped and it looks bad again, you can always get back in. Why? Because if you're right, you're talking about 10 points. So I don't worry about like 20 or 30 cents. So those are the shorter term, sort of like swing trades because you're trying to stay in longer. Good question. Here you go. I was just showing this morning in the Chart Patterns Mastery and the Options Room. Just did this. I'm very fast, fired up. I just showed it. So here you go. On a day trade, I take 4 hour, 1 hour, 15, and 5. This MACD is incredibly important. It's incredibly important because if you short right here, like earlier, when the MACD is that oversold, and we know that the NASDAQ is at support, the probability you're going to make money on the downside goes down dramatically. So let me clear some of these drawing set, and let me share this with you. Really, I should have made that plural. Should have made that plural. So, just keep that in mind. Let me go put that in the other. So, and the Chart Patterns Mastery Way already has it. Now, let me just tell you about AI. It's a great question about that stock. There's no way I'm playing that from the long side until I see a reversal pattern. As you see on multiple time frames, definitely it's at support on a 4 hour. Definitely at support, but I don't see anything that's telling me to buy it yet. If I even thought about buying it, you got to buy it with a ridiculously tight stop. Now let's go back a couple of days. And where would you buy AI? You see, it just doesn't have this structure. It has a bad structure. How about back here? Darn right. Look at these bull flags. Look at that bull flag. Bull flag. The point is, it'll tell you, well, I don't want to be corny, but you want to see some kind of bullish pattern on at least some kind of time frame. Even if it's a 1 minute, you got to see some kind of good pattern. You see a little bull flag there, then you see the bear flag there. Yep, you can play it to the downside too. Now, is that a bull flag? Maybe. But if you did mess around with it here, you better have your stop at the lows. So, but if you go on my multiple time frames, it just doesn't have it. So I hope that answers your question. But going back to it, definitely you see what I see. I go on the NASDAQ first. That sure looks like a bear flag to me. Right there. So why hasn't it gone down? Because it was oversold down here on an hourly. But the 15-minute, this is what I mean, and I'm a broken record about something working off its oversold poorly. So it got that oversold I told you about. It got back over zero, the short-term MACD, while this didn't go up. Now, I would have loved to see this hourly, be back up at zero so everything's lined up. But to me, for this on the MACD, and I can't tell you how important this MACD is. It's an art, not a science. I've been using it for like 40 years, but that is working off its oversold very poorly. Now, here's another thing. If you're a day trader, you would have to go to that. So if you want to short it right here, you better have your stop in there, right in there. If this doesn't hold, yeah, you're talking about a lot lower. So, and like I said, multiple time frames. I hope that helps on the multiple time frames I use. So definitely you saw the weekly or monthly breakout in corn. You saw the weekly or daily breakout in the agricultural index. And now you see this. Yeah, this better hold. This could get pretty exciting. Now, this is another thing I do when you're talking about shorter term trading. When I see this type of pattern, I want to be sure the stocks that are in that group aren't like doing this and going straight up. You want them to look like they have a lead blanket on as well. The biggies. Well, I think you see they all look bad. So that makes this more likely to break down. And I mean, that's how I try to do it in there. And I hope that gives you multiple time frames. Now, if you're looking right now at like, I want to do a swing short. So I want to do a swing short right now. And the problem is, are you longer term starting to roll over? Not really. So if you want to do a swing trade on the short side, sure, you could initiate short term, but for a swing trade, I want to see this. First, I want to see it under that ATR trailing stop or the 50. That's number one, like back here. Then I want to do swing trades to the downside. Even here, it's over things, but at least you can draw some kind of trend line. That's the big problem right now, is even if I'm bearish, it hasn't really formed that topping formation I'd like to see. I would like to see it do that, then come back up right to the resistance, and then you have a definable rectangle. And then I'll get real bearish. Right now, the only reason I'm real bearish today is because of that bear flag. I'm not sure. I mean, you see it a mile away. And the other thing, so that's how I do the day trading. Now, if you want to do long-term trading, you can go month, week, quarter, month, week, and daily. So you can just manipulate these time frames. So now you might say, well, why isn't the NASDAQ breaking? Why on earth isn't it breaking yet? And the only thing I can think is because of that. So what's happening is you need these MACDs to recycle so you have enough ammunition to plow through this. But yeah, if it doesn't hold here, you're talking about down here. And the worst part, if it goes down there, it's just developing a top. So, I mean, so that's how I'm looking at, do I do long-term trades in here on the downside? I'll do short-term trades, which means more day trades when I see that pattern. But long-term trades, I want to see more of this. AMD. If I see a stock do this, I hope you see the difference between this pattern and the ES or the NASDAQ. This has already tested the highs and then has a defined trend line. that it broke. So if I'm going to play anything to the downside, it's going to be stocks that have already topped out, already rolled over. That way, if the market rallies, heck, it could still go down. But that's the way I try to do these. Gaps, funny you mentioned that. Yeah, heck yeah. That's why I want to play AMD later because of that gap. Now, gaps, I know everybody says gaps have to be filled. It's not that they have to be filled, it's that if this goes down, the path of least support is to the gap. So, darn right, I look at gaps. Apple is notorious for filling gaps. This one, it didn't fill amazingly. Most of them it fills. So this one, usually a breakaway on earnings, it's not as reliable. How about the SPX? Is that candle enough to fill the gap? Well, let's see NDX. Maybe. But yeah, darn right, I look at the gaps. So I don't look at the gaps like, let's say it's right here and looking like it's rolling over. I'm like, yeah, it's going to go fill the gap. No, I don't do it like that. If I see a bull flag or a bear flag, yeah, then I'm going to be like, boy, there isn't a lot of support till that gap. So unfortunately, I got to get going, which really bums me out. Definitely watch this today. Let's see if this bear flag breaks. That's what I'm going to be watching the rest of the day. So I hope you enjoyed that. Hope that helped with some of your questions and have a great